Credit unions versus banks. What's the difference? Which should I bank with? Does it even make a difference? Where am I going to get the most value? Should I do both? These are some of the most prominent questions that have been asked for years when it comes to financial institutions. Many of us don't want to take the headache on of doing a bunch of due diligence on the best place for us to bank, so we go off word of mouth. This video is going to give context on the difference between credit unions and banks, the value difference, and giving you a roadmap on where you should bank, when you should bank with them, based on your particular financial goals and objectives. Before we get into this video in much depth, as you already know, I love to give context on who I am so you know who you're getting this information from. My name is James Phillips, a career banker and financial services professional, 13 plus years in the industry. At the time of this recording, I have an active mortgage loan originator's license, active FINRA investments license, active life insurance license. I'm small business certified for banking, cash flow management, and lending, helping consumers from the just starting out to the working class, all the way up to the 7 and 8 figure net worth position. And I'm helping small businesses that are just starting out all the way up to 6, 7, sometimes 8 figures in revenue. So with this being the case, you're getting this information from an industry insider, if you want to say that, somebody who's been working in the field for a long time and who has had success, both credit unions and major banks and financial institutions. So before I get into this much further, now that you have context on who I am, I want to start this off by saying you have to do your own due diligence. Pivotal for you to look at your financial situation, what's available to you geographically as well as virtually, and make the best decision for yourself. This is going to be more of a roadmap or a blueprint on which can be a better fit for you and the structural differences between the two to help you understand where you might fit to get the most value, to avoid fees, to get the best returns, and to get the most access to capital if that's a part of your financial game plan. So when you look at credit unions versus banks, the biggest stark difference is banks are going to be for-profit private entities. Credit unions are typically going to be non-profit entities. These are going to be two different structures and two different objectives at the core of their business model. Who they're looking to serve is going to vary significantly at some points. There's divergence between the two. Banks are typically going to be beholden to shareholders or some private investors, of some sort, family funds, things of that nature. They're for-profit. There are individuals who have put their money behind these banks, or these banks have capitalized themselves with an intent to make money and pay back those shareholders or pay back those investors. When you look at credit unions, that is not how they're structured. They are nonprofit entities. They are created and derived with the member of the institution being the owner of the institution. If you want to call it the shareholder, that basically means when you join a membership at a credit union, you are a part owner in that institution immediately. Unlike private banks where you have to buy stock or some kind of vested interest to have ownership in them. So that means who they're looking to serve on the onset immediately diverges between the two. Banks are going to be looking to serve their shareholders. Now, ideally, they're going to serve their shareholders by serving us as the end user and growing the business. But there will be times where that won't be the case. Credit unions at heart are looking to service their members flat out. They are not looking to appease or serve or meet the needs of any other entity primarily other than the member owners. And that is where you're going to have a divergence in how they serve, who they're serving. So when you look at the product lineup, you look at big banks, they're going to roll out strict product lineups most of the time that are going to fit the business model that they feel is going to make them the best profit. And it's going to fit the demographic that they're going to serve, who they plan to reach in their business model. And so what you end up having is a scenario where big banks or regular banks are more rigid. They tend not to have as much product diversity, and they tend to have less product flexibility than credit unions. And so that's not always a bad thing. It just means that, again, you need to understand this, and you need to understand what you're looking to accomplish financially with your banking needs and your money and your financial objectives. And you need to understand on the other end that credit unions are typically going to be more flexible and have broader product diversity. They are looking typically to be a marketplace solution for the working class and middle class of this country, typically speaking. When you think about credit unions, they typically serve teachers, military, firefighters, police, etc. They serve public servants. They serve local communities. Their community engagement is different. They are not always looking for bottom line profit. Now, it doesn't mean that they're not looking to make a profit. They have to operate a business still. They definitely still need to make money and drive revenue. but they go about it significantly differently, and it allows them to roll out different products that are going to serve their community and serve the demographics surrounding them, because most of them are geo-restricted, and if not geo-restricted, they're member-specific. So that means like Navy Federal, that's military focus, government focus, and the NASA agency, and there's just example after example. So there's different restrictions, and they're going to roll out product lineups based on the demographics in their area and who those and the members they're looking to serve primarily, and their families. So that gives them an edge in that department. Now, on the flip side of that situation, big banks are going to typically be much more friendly as you have more assets and resources. If you pay attention, you notice that credit unions, even the biggest and the baddest in the country, like Navy Federal, they don't have very much in the line for those who are more affluent and have higher levels of wealth, or businesses that have higher revenue and lending needs. Navy Federal has a relatively low surface business product lineup, and they don't have much of anything for people with 6 and 7 figure net worths when it comes to product lineups and servicing. And that's an interesting observation, because what that tells you is, again, at the core business model, they're not looking to service that demographic of people as much. Their implementation was largely based on being a marketplace solution for the everyday person, Main Street, if you want to call it that. Big banks are different. When you look at Chase Bank, Bank of America, you don't really scratch the surface on the real value they can offer until you have about 6 figures in net worth, or 6 figures in assets on the book, rather. Not necessarily net worth, because your net worth can be in gold, silver, cars, whatever, and that doesn't do the bank much good. But when you start talking about cash, stocks, bonds, real estate, business with business revenue, business balances, etc., when you have 6 figures there, that's what it takes to scratch the surface on your Chases, Bank of Americas, Goldman Sachs, Wells Fargo. And if you go down to even super regional, and sometimes even local banks, you will still notice as small as some of them get. Examples in my region are going to be Hancock Whitney. That's a regional bank that's pretty much running the Gulf South. Think Louisiana to Florida. It gets even more niche than that. When you think of a bank in my state called Red River Bank, they are regional and almost state local financial institutions. They still have private wealth departments. They still have private bank departments. Literally, as small as they are as institutions, they're not at the scale and scope of a Navy Federal, for instance, or at least the Red River Bank isn't. I'm not sure about Hancock Whitney, but they still have dedicated departments for those who are emerging affluent, 6 figures, to low 7 figures, and those who are affluent, 7 and 8 figures. That's not the case with credit unions. And so this is an important distinction. This is an important foundation when you start thinking about, where do I bank? Where do I get the most value? Where can I eliminate fees based on what I can provide as far as a banking relationship with the bank? Where I am with my assets, with my cash position, with my income, etc., my lending needs. This is important. If you're somebody who is emerging affluent or affluent, and you're trying to shop the best option, or you're considering moving relationships and you're not sure, then credit unions on average are maybe not going to be as attractive for you. Because depending on your needs, if you're somebody with upper 6, 7 figures in cash deposits or investment needs or lending needs, then credit unions tend to be more limited. Very seldom do you see them have extensive retirement departments and private bank, private wealth departments, if at all. Because again, they weren't designed to help that group of people. Banks meet that need many times over. Private banks meet that need. And that rolls me over to the other end. If you need product diversity, if you need those entry-level products to start building out your credit, your basic banking needs when you're just getting your first job or getting back on your feet financially, and you're not making a ton of money, and you need fee-free checking accounts and savings accounts. You don't have a ton of money, but you still want to save and get some decent interest on your money. You have $1,000, $5,000, $10,000. You're not going to get much at Chase or Bank of America. The CDs are okay, but there's not going to be high-yield savings and basic savings products there to help with earnings needs. Chase Bank doesn't offer any unsecured personal loans. So that's another example versus credit unions. They're going to almost always offer personal, secured or unsecured loans, diverse recreational and auto loans, etc. Chase Bank doesn't offer that. Bank of America, limited. Goldman Sachs, limited. So this is where you need to put a frame of reference around your banking needs, reevaluate your banking relationships if you're new going into banking, or if you're well established and you're nearing retirement years and you just want to reevaluate your finances and make sure your money's in the places it needs to be. If you're a solopreneur or running a really decent sized small business operation, the same rules apply. You have to know where you're concentrating your economic and financial power, period. And banks serve a different need, and don't get me wrong, they cross-reference all the time. They cross over all the time. Credit unions and banks will have shared servicing abilities, but as you can see, as I laid out in this video, there are distinct distinctions between the two, and very important in you understanding, okay, well, based on my financial position, my financial needs for now and the foreseeable future, big banks aren't going to be where I can fit because I don't have the type of banking relationship where they're going to value me and I can avoid fees and get high levels of service. So maybe I do just enough with them to get the technology that they offer and the branch footprint they might offer, but I'm gonna do the bulk of my banking at a credit union, or my local credit union, or a credit union that I fit as a member. The same goes the other way around. Emerging affluent, I have $500,000, $1 million, $2, $3, $5, $10 million, and I need a bank somewhere that's gonna roll out the red carpet, that's gonna give me specialty hands-on advice, that's gonna give me a suite of professionals to work with, to surround me, to protect my money and make sure it's growing and meet my lending needs. Same thing for your small business if that's where you're functioning. Then credit unions are probably not gonna be where you need to be. So I wanted to put context on this because this is something I'm encountering every day when I service clients. And I'm encountering this as I branch out in the financial world and do events and more speaking engagements. People are still confused on this topic, and I wanted to give some context on it because clearly I have a big focus on banking because I believe banking is one of the core foundations to great financial health in this system. And knowing where to bank is gonna bring you tremendous value and tremendous time-saving capability, money-saving and money-earning capability in the long run with your finances. Comment down below and let me know what your relationship is like with credit unions and banks, private banking institutions of all sizes. Let me know exactly what your relationship has transitioned out to be in the sense of what it took for you to bank the way you bank. Did you have bad experiences with private banks and realize credit unions were a better fit? Was it the vice versa? You realized credit unions were limited and you needed a bigger pocketbook and some more specialty service than they can provide you at credit unions, so you don't do your much heavy banking at credit unions. Comment down below and let us know what your relationships look like and how they got there. To all my pioneers, welcome back. To my new viewers, welcome in. I want you to continue to support the channel by commenting, sharing, and subscribing so this channel can continue to support and invest in you. As usual, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.